through speed and through tokenization, AI is reintroducing the element of personalization. So personalization will not come in the form of direct peer-to-peer finance, but that because of the need for completing a transaction very quickly and through autonomous agents, for example, and the fact that you need tokens carrying instructions to complete a transaction, AI is disintegrating the role of intermediaries in finance. I don't know if all this makes sense to your audience, but very simply, finance today, the bank stands in the way of us and our money, and in the way of two people transacting with each other, whether it's a bank or a licensed institution. Decentralized finance promised that this intermediation will disintegrate over time, and that technology will make it possible for individuals to interact with each other directly. For one thing, because of AI, you and I can create agents to represent us in a transaction. And the agents can represent us in our lifestyle. Like when you want to buy a ticket or you want to complete a transaction, you give all of the instructions to an agent that you create, and the agent interacts between you and the financial institution. Right now, the way banking works, the financial institution dominates the relationship or defines the relationship. So they provide you with the platform, they provide you with the user interface, they provide you with the user experience and the whole flow of the transaction. But when you create your own agent, simple things like an app that the bank creates for you to interact with the bank becomes totally irrelevant because you decide how you want to interact with the bank. I'm good. You've been asking very good questions.
Our guest today is Emmanuel Daniel, founder of the Asian Banker and Tab Global. He's educated at the National University of Singapore and the University of British Columbia. He has spent decades analyzing banking transformation across Asia and beyond. He's the author of The Great Transition, which focuses on the personalization of finance, and the upcoming book, Building the AI Bank, where he explores how AI, tokenization, autonomous agents are reshaping the foundations of finance. Emmanuel argues that we are entering an era of personalized AI-driven banking, where institutions must reinvent themselves or risk becoming irrelevant. It's a pleasure to welcome Emmanuel Daniel. Thank you so much, Emmanuel, for joining Expanding Horizon. It's great to have you on the show.
Thank you for having me, Neil. I've watched some of your previous interviews. They're quite eclectic, and so I'm curious how this conversation will evolve.
So I want to start off first with your book that you wrote, The Great Transition, that covered personalization of finance and other topics. So you wrote this back in 2022, before like the AI explosion took place, before ChatGPT came out, etc. So have your views since then changed post AI LLMs?
Brilliant question. Coming on a book that has been written in 2022, and actually, I'm just about to release my second book, which is Building the AI Bank, and then I'm going to do a revised version of my first book, The Personalization of Finance is here. When I wrote The Personalization of Finance, I still believed that the institution will be disintermediated. Finance will be something that individuals do directly with each other without an intermediary, by and large. The technology will evolve. There will be different types of intermediaries will evolve as well, but the end result really will be that the peer-to-peer model will succeed and will triumph. That's not entirely how it's evolving right now. The intermediaries in finance are still well and alive and demanding to have a role in the future of finance. And they've come in the form of even the intermediaries in the in DeFi, decentralized finance. The role of intermediaries are still there. And in fact, they are in the form of the owners of the DeFi platforms, the promoters of the DeFi platforms who are large and well funded and insist on playing a role in decentralized finance. But AI is introducing a variation on the theme of decentralization and the personalization of finance. Through speed and through tokenization, AI is reintroducing the element of personalization. So personalization will not come in the form of direct peer-to-peer finance, but that because of the need for completing a transaction very quickly and through autonomous agents, for example, and the fact that you need tokens carrying instructions to complete a transaction, AI is disintegrating the role of intermediaries in finance. I don't know if all this makes sense to your audience, but very simply, finance today, the bank stands in the way of us and our money, and in the way of two people transacting with each other, whether it's a bank or a licensed institution. Decentralized finance promised that this intermediation will disintegrate over time, and that technology will make it possible for individuals to interact with each other directly. And that theme, even after I've written my book, floundered a little bit because intermediaries didn't go away. And so I have to now introduce the element of AI and how it will eventually bring about a form of personalization of finance, and that there are a number of new rules that come into place. The need for instant transactions, the need for speed, and the need for identity, meaning that because of what AI makes possible in terms of fake identities, the importance of validating transactions are far more important today than ever before. And because of these three elements, the intermediaries themselves have to transform themselves. So a bank today, for example, takes money from you, sits on that money, makes interest by lending that money out, and whenever you want that money, it takes 3 days to return that back to you. And while it sits on the float of 3 days, whether you want it back at the ATM or when you're making a transaction to somebody else, the bank is making money on the float. AI is disintegrating that, in that transactions have to be completed immediately, instantly. And decentralized finance has brought in a whole universe of models in finance where finance has to be settled in instantly. And so banks have lost that opportunity for making money. So now they have to reinvent themselves to be relevant in a transaction by being able to support the speed of transaction, the validity of the transaction, and the identity of transaction instantly. So the idea of banks will evolve, and the role that they play will be very different in an AI model. So when you think about AI will sit not it sits at different levels, different layers. For one thing, because of AI, you and I can create agents to represent us in a transaction, and the agents can represent us in our lifestyle. That like when you want to buy a ticket or you want to complete a transaction, you give all of the instructions to an agent that you create, and the agent interacts between you and the financial institution. Right now, the way banking works, the financial institution dominates the relationship or defines the relationship. So they provide you with the platform, they provide you with the user interface, they provide you with the user experience and the whole flow of the transaction. But when you create your own agent, simple things like an app that the bank creates for you to interact with the bank becomes totally irrelevant because you have to decide how you want to interact with the bank. And so the bank has to create platforms on which it can accept agents and it can transact with agents securely. And that agent is really dependent on what you create. And then on top of that, your agents can actually sit not in your wallet, not only in your wallet, but also in the devices that you use in your everyday life, whether it's in your car, whether it's in your refrigerator, any of the utilities that you use. And you can create agents that actually interact with other agents to complete a transaction. And part of that completing of the transaction involves a financial aspect, which is the payments to be able to complete the transaction. And so the banks have to be there when the agents are talking to each other. So that's the world we are entering in now. That world actually already exists. I've created agents of my own, and I'm not even a programmer. And so it's a matter of time before kids create their own agents. And it throws up a whole range of new problems for the banking industry: validating the transaction, completing the transaction instantly, having the liquidity in order to be able to complete the transaction, all of that. AI is redefining finance dramatically. Now, the way in which the banking industry has been responding has been to look at all of the technologies that are evolving simultaneously. So you have AI evolving simultaneously with tokenized banking, for example, and trying to make sense of what the new ecosystem will look like. So we have, for example, the development of stablecoins, and that's been a development that has been parallel to the banking industry. And the reason stablecoins are becoming a universal payment platform is because millions of small businesses around the world, especially in developing countries, cannot wait to get a bank account and then plug into the banking system to participate in the global economy. So a small merchant in India can sell his wares, his handicraft around the world just by having a website and completing the transaction using stable coins. And this is exactly what's happening in a number of countries, in Tanzania, in Nigeria, where the trust in the local currency is not good. At the same time, the banking industry is not responding fast enough for the small businesses in these economies to participate in the global economy. So because of these parallel developments, the banking industry is trying to create an architecture that works for them. But in the end, they will have to follow the architecture as it's being created. So there's lots of moving parts right now. And then on top of that, the US has become pro decentralized finance, crypto. Um, and because of that, there is the possibility that banks will issue their own tokens eventually, either in the form of a tokenized deposit or something which is effectively a bank stablecoin. I'm saying a lot of things all at the same time, uh, but uh, but just to respond to your question, which is how has things changed since I wrote my book in 2022? Things are changing, not necessarily in the way that I originally, imagined it to be, but dramatically. And we are, if not personalization, we are moving into a world of proto-personalization, which is, personalization before personalization. In that it looks like personalization, but the moving parts are being created in the process.
There was a lot to unpack there. We'll get onto the topics of AI and stable coins, I think, little later on. But I just want to ask you a little bit more about your book before we move on. So you mentioned a lot about these intermediaries that are still there and these changes that are going to take place. So are there any markets that you're seeing in Asia or perhaps elsewhere that are leading this transition towards like personalization? Do you
It's a
already see that
global
happening?
global a global phenomenon to the extent that you can transfer a cryptocurrency to me directly without an intermediary. That's already personalization. So it already exists technically in the decentralized world. In the centralized world, to the extent that you are able to replace a traditional transaction with a stablecoin transaction, that's also personalization taking place. But the elements of personalization includes where you will be using those transactions. Right now, when you want to make a banking transaction, in the old days, you have to go to a financial institution, wait for it to open in the morning, take your money out, and then hand it over to somebody else. That's how it used to be. But in the future with AI, your autonomous agent will just complete all of that online instantly. So that's also a form of personalization. So personalization is actually a pretty broad concept. What it attacks most is the role of the intermediary itself.
And you spoke about these autonomous agents, right? So is this something that individuals will create themselves, or will we have like companies creating this on our behalf? And doesn't that lead to more intermediaries? Don't we now have like an AI layer that's coming up?
The difference is that the intermediary belongs to you and you
Yeah.
decide what the intermediary does. And yeah, you're right. That there are multiple forms of intermediaries. The institutions themselves will create their own intermediaries. There's a huge battle underway that started with what I call the API revolution. In the API revolution, because of the cloud, the IT companies had to allow end users to create their own APIs. But the banking industry got away with it because it's regulated. They did not allow the end user to create their own APIs. They only allowed their trusted partners to create their own APIs. And so the strength of the relationship and the power of the relationship remain with the financial institution. But with AI, because there will be a multiplicity of agents, agents are a new form of APIs. And so banks have to understand that the APIs now will increasingly be created outside their structures, and they have to plug into those APIs to be relevant to society going forward. So there's a huge transition underway. In fact, the title of my book was the Great Transition. It is a great transition. It's a slow transition, but it's all the elements are coming into place for that transition into personalization.
There is also regulation that comes into picture. For example, like API, we didn't have it because of regulation. And now we also have AI coming into place. Do you think regulation will again get in the way of AI? Because it has in the past. And when I look at, like, for example, my bank page or open my bank app, not much has changed. You have few designs, but fundamentally it's still the same thing. So now with AI, we are expecting this massive change with all these agents. But again, regulation could again step in here and, block these things. So is it different this time?
Excellent question, an important question. How are regulators going to respond to the transformation that is underway? Regulators still believe that they can pace the evolution, they can pace the process, they can still be in control of the process. But when a lot of transactions outside finance, when you go and send your car for repair, you don't even have to turn up at the repair shop. You program your car to be autonomous and drive itself to the repair shop. And the repair shop has already got the full information on the diagnostics of your car because the software is uploaded to the repair shop. So when everyday life becomes entirely dependent on autonomous agents talking to each other, the only part that's missing will be the financial aspect, the completion of the transaction. Something that I tell regulators and I tell banks, which they don't yet understand, is that the data outside the institution is going to be far more important than the data in the institution. Regulators, when they control the banking industry, what they're saying to the banks is that data that you have on your customer is very important. You cannot let it go under any circumstances. You got to be very careful of who has access to it. You cannot let your API partners to have access to the customer data. But what is the customer data? It is static information on you. It's the money that you had 1 minute ago. It's the transactions that you did yesterday. It's your credit risk profile as you looked like last month, and everything that's historical about you. In an AI world, AI needs to deal with information that is current and instant. The historical information has no meaning at all in AI, and all of that exists outside the banking industry. So the banks now have to figure out how it can have access and participate in the data sets outside the industry to make informed decisions about the end user. And when the game plan changes that way, regulators now have to be reactive rather than proactive. They've been able to be incredibly proactive in all the evolution that's taken place in finance up to today, but they're now coming to a point where order takers rather than order givers in a financial transaction, they're going to be. And so that role of regulation has to change. What I say in my book that's coming out is that changes the role of banking or security in banking to be something that is already a common phrase, human in the loop. At which point does human intervention comes in an otherwise totally autonomous transaction to either stop or moderate a transaction or to put in rules. And so the regulator has to figure out where in a transaction does the human in the loop comes in. And everything about finance will be about governance rather than control. Governance means that you can't control everything, but you put in place the rules by which if something goes wrong or something needs a review, you are there to make those reviews. So the game plan on regulation itself is transforming dramatically right now. And I have not seen any regulator responding to, rather creating the thinking required to be prepared for the world of autonomous transactions yet.
There's a point. There's a point on open in the loop. So recently there was this whole issue with Anthropic and the Department of War. There was an issue with having mass surveillance, autonomous agents, and the creators of Claude itself are worried about the capabilities and they don't want these autonomous agents running wild. So you are fairly, I think, positive and optimistic on this front. So what are your views on this recent incident, and does that change the dynamic of how we view autonomous agents, where we should have, in fact, more caution, more humans seeing what's happening and not.
I'm not positive about the whole evolution. I'm just saying that it's inevitable, and so we need to start thinking how we deal with the elements. So a level of governance needs to be put in place where the either the LLM or the owner of the transaction has to say what are the governing rules in my participation in that transaction. Where will I draw a line and say, I would not participate? Where the state becomes powerful, where the state takes up information that it's otherwise not entitled to, things like that. So those are the governance elements that you can put in place, and where the human in the loop comes in. And I think that even right now with Anthropic and the state government, the Department of State in the US and the Department of War, right, in the US, asking to use its technology for nefarious, purposes. I think that all of us need to have an idea of where we draw the line in terms of a transaction and what we will do or what we will not do. And this is the transaction as opposed to internal to the transaction. The transaction operates autonomously, but within the rules that you've set for it. So it's just a different mental paradigm that we need to become accustomed to over time. The elements are still being built through every incident, but we'll need to see how that evolves.
And how will credit scores change? For example, now we have this. Um, Earlier, for example, bank would only look at their internal data. Now we have AI coming into place. So there are these external data points as well. How would a credit score, for example, change in that way? Will banks start collecting information from external sources, or what additions or subtractions do you think will take place, and how the whole credit score and credit risk is?
So the technology on credit score has evolved dramatically. In countries like China, you've got Alipay, for example, which uses much more dynamic credit score parameters. WeBank, and the US is really far behind on this. I think that it will change dramatically when the product itself transforms. So something I said in my book was that take mortgages, for example. In many countries, mortgages, in order to be able to secure a mortgage, it can be an up to 6-month process. You do a search on the property, you got to go through the whole legal process of securing the title deed, and then and you make sure there are no encumbrances and all of that before the bank actually provides credit on a mortgage. But as the mortgage itself or the title deed itself becomes digitized, a title deed search can be done in an instant. People can buy houses or buy homes or buy property instantly. So the bank has to now meet that instant information by being able to provide credit instantly. Now, when you're able to provide credit instantly, the nature of mortgages changes. People don't buy property, over a 6 month period. They can buy property and sell property over a 2 day period, a 1 day period. Then and when the next generation, say Gen A, are thinking of property, they're not going to think about property the way that the old generation did, which is that you study properties, you secure them, and you hold them for a few years at least, because just that whole process was so difficult and long-winded. A property becomes a tradable asset that you can buy and sell at will to create your own cash flow. So when the product itself changes, the supporting credit has to change as well. And banks have to realize already today that there's any number of data that sits outside the banking industry, and WeBank has shown us this, that just taking stock of your phone list on your phone and the people you have as friends and how many of them are corroborated by the bank as being the bank's own customers or people with jobs or whatever it is, tells them more about you than whether you paid your bill last month. Whether you paid your bill last month is historical information, and banks have to make instant judgment on you with present information, if not future looking information. So that entire evolution on the credit front has already started, and the more progressive banks have already started plugging into lifestyle information: where you live, and where you work. At what time did you do your credit card transaction? Because if you did it at afternoon, it probably means that your job is not very important. If you did it over the weekend, means that you've commitments in the weekdays that allows you to only transact on the weekend. Any number of parameters that gives a better profile of you than static information gives you today. And then on top of that, is the liquidity element, which is you as an end user want instant liquidity, meaning you may want to borrow money only for a day, and the bank needs to be able to give you that liquidity in the time that you need it. So the whole nature of banking, what we call products and what we call the credit profile, will need to become more instantaneous and current rather than historical.
It was very interesting, and it'll be exciting to see how this will change, and it will have so much more personalization into it. It was the point around stable coins that was brought up earlier. So banks and traditional banking regulators have sort of been cautious about crypto and kept their distance. So do you see that dynamic changing where banks will become more open to stable coins, central governments will become more open to stable coins as well? Will that change?
The banking industry responded to cryptocurrencies by proposing to introduce their own version of crypto called CBDCs, central bank digital currencies. And now a number of jurisdictions where they've either introduced or trying to introduce CBDCs have found that they don't work, and people just don't trust the central bank issuing a token that can be controlled and where they can monitor the end user and so on. And also, promoting any new form of payments requires a lot of marketing energy that central banks just don't have the resources to do. So the global regulator for banking, the BIS, the Bank for International Settlement, has started talking to banks about tokenizing their deposits. In other words, the issue of the CBDC now is the banks themselves. But when banks tokenize their deposits, it begins to look like a stable coin because it carries the value in the local currency. Whether it's issued by a bank or a stablecoin issuer, institution has to guarantee that the value is one-on-one on the token. And they're even talking about tokens that can be programmable tokens. Now, there are a number of banks around the world that are running pilots right now on this tokenized deposits, except that they're all very nervous about what it actually means, how it will influence usage, and whether when you make it tokenized, that the tokens can be stolen literally by the competing bank just by giving better rates, better facilities on the token. In other words, just by providing highly valued digitized promotions, that the market share of tokens can change dramatically very quickly. Because right now, banks compete intensively with each other for market share of deposits. But deposits has a different mechanism to them in terms of winning market share. A lot of it has to do with how much interest rates you give on a deposit. But a token, you can actually win a token war by providing more utility rather than interest rates. Things like that. It's more technology driven rather than by bank interest rates, which is on the cost of funds of the banks. So the banking industry is already there. They're already running pilots, but they haven't launched them because they're not sure. Then comes on the side wing the whole stablecoin proposition, which today has actually become crystallized simply in the idea that the US dollar stablecoin issued by Tether and Circle dominate the whole stablecoin universe. Those are the two stablecoins that account for more than 80% of the stablecoins issued around the world. All of the others, whether it's the euro or the local currencies in Singapore and in Switzerland and so on, they don't count for very much. And the reason is the world is constantly looking for a global currency which can be trusted and understood by all players, regardless of where you are. The US dollar is still the best understood currency and is still the best trusted currency. And so when it's converted into stable coins, it seems to still be the most successful one. Now, assuming whether it's a US dollar stable coin or not, Tether is already by far the leader, even against Circle. What it seems that is happening is that there is going to be a standardized form of currency that everyone in the world will subscribe to. And the only thing is that this form of standardized currency is not regulated by any one central bank, except for the fact that it has a one-on-one exchange rate, and therefore de facto, if it's US dollars, it's against the Federal Reserve Bank's idea of a dollar. But the most important reason stablecoins have become so successful is because they're very simple. And it's understood by all end users, and it works, and it's trusted. If one day, say, Tether gets into a governance problem and is not able to meet the one-on-one exchange rate, then that whole Tether proposition will collapse, and then we'll find that stablecoin becomes questionable again. But right now, it seems to be working very well. You know, the funny thing about global domination is that the key operating principle for global domination in finance is simplicity. That any form of tokens or currency has to be understood simply by all players. And the second really is liquidity, meaning there's sufficient of that currency or token circulating around the world for it to be easily accessed and exchanged for value. And the dollar is the only one that conforms to these two important criteria quite well right now. But as stable coins become more successful, what it does is it puts pressure on the traditional banking system to respond. You have to be instant, you have to be 24, and you must have very little back office, and you must cost almost nothing to transact. You know, these four criteria. And what it does, it puts pressure on traditional banking to come as close as possible to these four criteria.
And how does that change monetary policy? Because now, if everyone relies on USDT or USDC, local central banks will no longer have that control over monetary policy. So there will, of course, be some, I think, pushback from the local regulators on just relying on like USDC, USDT. They would probably want their own stable coin. And some would argue also that this creates like a shadow banking where we now have this parallel privately issued dollars, so to speak. So what are your views around that? I see it as more like a pushback coming from the regulators.
So that's another theme in personalization of finance, where the whole idea of tokenized finance is that you, Neil, can issue your own token and issue it and distribute it to your friends and family. Okay, and you say that my token is worth $20 US. And it's worth $20 US if your friend and family trust you and accept that it is $20 US, and they use that same token to transact with someone else. And that's what a Bitcoin was when it started. It still is, and technically, any one of us can issue our own Bitcoin, our own crypto, and there have been several attempts at doing this, sometimes fraudulently. So we remember FTX, and Sam Bankman-Fried, where he said, my token is worth 100. Any number of global investors trusted that, and he was able to use the value of that token to borrow money from his own bank, and then it all collapsed because it was always a Ponzi scheme. So the thing is that the technology and the theory exists for tokens to be issued by anybody. And the reason it's not issued by anybody is because not anybody is trustworthy, and nobody trusts anybody unless they come with a proposition or they build a ecosystem that is sustainable. Donald Trump issued his own token, right? And what a farce it was, because it went up in value and then he pulled out and profited from it, and there are a lot of people left holding a Donald Trump token. So the world will go through several iterations of this until a stable ecosystem eventually evolves that sets the rules for what a token is and what value there should be. Now, the reason I say all this is because central banks will lose control over the value of their fiat currencies if they continue to behave badly. Insofar as central banks continue to flood the market with more liquidity than it can absorb, so far as central banks are helping their respective governments to fund their deficit budgets, increasingly in the red, and so far as central banks don't know how to respond to inflation, the alternative is real and is standing alongside to become the operating currency. Right now, what's happening is that as many central banks around the world are trying to move away from the dollar as the operating currency, and US treasuries as being reserve currency and reserve contributing to their reserve status, they're all investing in gold. And so gold prices have gone up dramatically. But gold is not like US treasuries. US treasuries pay a yield. Gold doesn't pay anything. So it's just a sitting asset, and you can use the same argument against Bitcoin, for example. And as long as gold prices keep going up, the central banks that are hoarding gold will look very secure. But when commodity prices turn and gold prices start to fall, those countries that have increased their gold holdings are going to be in very serious trouble, and especially if they are running successive deficit budgets. And so it's not going to be a good thing that you are holding gold today. And I think that we are getting to a point where central banks are losing control over their own respective economies. And that's where an alternative needs to be found, or economists will themselves look for the alternatives that they can trust. And the alternative, by definition, has to be 24/7, fully liquid, instant transactions, the four elements, right, and can be trusted. So that's why the crypto universe is operating alongside, waiting for the day when that an entire economy will just make that transition towards crypto economy instead of trusting central banks. So the long and short of what I'm saying is that central banks around the world are losing control of their respective economies right now, and their local populations will be looking for an alternative that they can trust.
Very interesting. I think it'll be interesting to see how it pans out and what it looks like in the future. I want to get back on AI and probably dive deep a little bit more on that. And I largely view AI in a very positive sense, and it's quite transformative. And you mentioned autonomous agents. So I just wanted to know like how you have been using these AI agents or AI in particular in your work, in probably the Asian banker, your research, writing, journalism. So how do you utilize AI at the moment?
At every level, operationally in our daily activities, I mean, in the operations of the company, right? So I tell my finance manager to plan his budgets using an agent. So create his agent, put in some parameters, put in the current the current data that is collecting on our accounts, and then project that into what it will look like by the end of this year, and what it will look like by next year. So in the agent, he has to put in the parameters in terms of what what will happen if our sales goes up, or if the economy goes down. What are the call signs? What are the red marks, red flags that he needs to be aware of, and all that. So he's building it step by step. That's our finance department, right? So all companies will need to learn how to use agents. On the business itself, we are a knowledge business, and we've got so much data from our historical work and all that. It's all been put on the cloud now, and our IT managers are working with our researchers themselves to put in agents that can actually interpret the data that we've got so far. And actually, to be honest, historical data does not, it's not linear to try and decipher future trends. And so we need to figure out, like, what are we looking for in terms of the future trends that we tell our clients. So that's work in progress. We're testing different agents. None of them are satisfactory. Let's see how it evolves. There's one place where we collect the balance sheets of every bank in the world, the top 1,000 banks, sorry, and then a few more below, so maybe 1,200 or something like that. Top 1,000 banks in the world, and we use agents to look out for banks that we think are the worst banks in the world, not likely to pay their dividends, have the worst NPLs, stuff like that. So the agents pick them out for us. And then we write our stories from there. So that's in the actual core work that we do. And in the core work that we do, we have standard operating procedures, and we're writing agents to tell new staff what they need to know in doing their work. So in the old days, it's linear that when you join us, you have rule number 1, 2, 3, 4, 5. But today, staff can go in there and say, okay, I'm doing this project, what do I need to know? And so the agent pulls out the information for them. That's actually coming along quite well, actually. So those are the areas that we are working with agents in our organization. The people working with these agents are not themselves technical, so except for our two IT managers. So it's interesting that they're learning as they go. It's not always perfect, but I'm forcing the organization to to zero in on using agents to get their trends and their analysis going. One other area I think is our social media and our marketing department. They can use AI to design brochures, design websites, and we use agents to be consistent, meaning that when you see this particular visual, it's from the Asian Banker or Tab Global, instead of going all over the shop floor. But that's work in progress. We're just building SOPs in there, the standard operating procedures, so that a new staff coming in can just take and work with the agents to keep it within brands and stuff like that. Yeah, and what it does to the organization is that it collapses the organization in that even a young staff is empowered to make certain decisions on their own, and therefore we don't need layers, but then that creates risks as well. So we're learning. Yeah.
But do you think the Asian banker itself is like vulnerable to AI disruption, with AI providing more research, analysis, writing? Do you see that as a threat?
Very much, very much. If half the research that we do can be done by our clients directly, they have no reason to subscribe to our research. And actually, 2/3 of the research that we do can be done by our clients directly. And I don't know if any other research company has told you this, but that's the kind of proportions that we're talking about, where the whole knowledge business or the whole knowledge industry is collapsing around us. Then the question is, what do people pay for? And the answer to that is that people pay for trust and people pay for relationships. The data is to support that trust and relationship. It's not the core product that people buy. So then we invest more in the one-on-one interaction, the telephone calls, the group discussions, things like that. People want to be able to connect with other people. The more the knowledge business is disrupted by AI, the more relationships become important.
Yeah, that's very true. And time also becomes valuable because while everyone has these AI tools, AI agents, people don't have that much time to actually go prepare these research, prepare and try to investigate. I think adding that value in terms of having that knowledge, the time, as well as adding an AI layer to it probably adds like more value rather than just getting the AI agent to
Actually,
do it
I
because
think
you need
I
a lot of context.
And therefore, the relationships are important because, excuse me, if it's in interacting with others that you create that context and that you justify, validate what you think you're thinking. So relationships become even more important. Something I find that I end up doing is I become what do you call this person who just keeps scrolling on information on the internet, right? I become a scroller, which is terrible because in a way I'm garnering information that I otherwise wouldn't know, but in a way it's wasting my time a lot from doing what I should be doing. So I think it's not just me. I think that lots of people, professionals around the world, are trying to work out what then should they focus on in order to be relevant in the future. So we are in the intermediary phase or intermission phase of having had our jobs redefined. So, for example, if I wanted to put together a chart on 6 countries that I want to compare on how the banking industry operates or the cost to income ratio or something, I can do that in an instant today. I mean, I need to validate the data that I have, but I can do it in an instant, and it gives me a rule of thumb, kind of a feel of the information I'm looking for. So then what do I do with the rest of my time? I think we are all in a process of redefining what we do with the time that we have. And when we eventually get to a point where we're using it well, we will find that we would have created a network of people with whom we validate information. And it's in that network where even transactions like crypto and so on comes in. I say this in my book that society is moving from its markets orientation to its networked orientation. Lots of things about the markets orientation. We going to be very different from the network orientation of our society when we eventually get there, when it becomes the defining nature of society. Network means that we are all one degree of separation from each other, and we can use each other to validate the information that we think we have, and therefore relationships become more important, and they're accessible. We're all in a node, which we are not in a markets environment. Markets environment, actually, you have more information than me, and when you transact with me, you're trying to complete the transaction with as much benefit to yourself rather than to me. In other words, there is a leverage of information in a markets setting. But in a network setting, we all have the same information. And so therefore, what do we do with it? And there are lots of different repercussions because of that. So, there's a discussion there that the entire economy will look different in a network setting, which we are getting into. And I'm spending a lot of time thinking about what a networked economy will look like and operate. And where value is created in a network economy. I'm doing some work in that area, and I've given some thoughts for that in my book, the building the AI bank. But I'm thinking of a future book where I'm actually looking at society as a whole as a result of being a network economy, and what that means to us both individually as well as institutionally, and as entire economies.
You made a very interesting point on information because now that that information asymmetry is not there, when everything is available, it changes quite a lot of things. That gaps, that market gaps, the opportunity gaps, will no longer be there once you have this efficient layer. Do you also think like asset prices and investor returns will also then go down? Like now that you don't have all this advantageous positions, do you think like public markets and asset prices, all the returns will keep going down because of this?
You hit the nail on the head. Will Bitcoin lose its value when it becomes the commodity in a truly networked economy? Big question. The funny thing is that in the glimpses that we've had, okay, you take taxi fares for example, or Uber. What does Uber do? It gives symmetry of information to all the participants. The person using the Uber, the person driving the Uber, the regulator, the Uber company, the person who's not going to use the Uber but is interested to know whether one's available. All of them have symmetry of information in that we all know where the Ubers are, and we all know what they're charging, and what the search prices, and so on. But did that reduce the cost of an Uber and make it more efficient and made it more available and enable the drivers to spread themselves out so that they go in for the high demand hours more than the low demand hours and so on? It didn't. Uh, with symmetry of information on Uber prices go up. And today we are paying far more for our taxi fares than we ever did in the good old days when you got a rickety taxi come up to your house because you called for it and waited half an hour for that. Same thing for flights and airfares. That the airlines are actually able to make more money because their fares are far more transparent today than they ever were. So that's a glimpse of what a fully networked economy would look like. So watch this space. How it evolves is very, very interesting. And why is it that there's surcharge pricing, or is there a surcharge or an increase in the cost of services? Maybe precisely because it's so much more efficient, it's made people much more mobile than they were before. I don't know, but the glimpses we are getting is that it doesn't result in a collapse of prices. And this is a tentative view for now, okay? But it'll be very interesting to see how that evolves.
We'll be entering uncharted territory.
I'm good. You've been asking very good questions. Yeah.
So, is there anything about banking in its correct direction that sort of concerns you, the way banking is currently headed? Anything that is genuinely concerning to you, let's say in the 5, 10 years?
In terms of morality and governance and what should an industry do and stuff like that, I've just come to a point where I no longer impose any expectations. I think that all industries are mercenary, and the people who shape the industries are self-serving. And because of that, it's actually the survival of the fittest, and should have evolved for the good of society. And an example that I use, for example, is inclusive finance, the phrase that they use. And what I keep saying to everyone is that inclusive finance was actually meant to make technology make finance available to the desperate poor, and the best practices that were evolved from the times of microfinance lending, for example, should have resulted in the cost of credit decreasing dramatically for poor people. But guess what? The technology has improved, the user interfaces have improved, the access to credit has improved, but the price hasn't dropped at all. Poor people still pay 30% for a credit when a rich person pays less than 3-4% for credit, and this is around the world. It's not just any one country. So in developing new technologies and new economic models, the people who fund them, usually the venture capitalists, want to be rewarded. And so when they build these models, they build them for profit at some point. The whole idea is profit motivation, and therefore, finance doesn't become more equitable as a result. It becomes even more mercenary and prohibitive, and so on. So the morality part, I'm afraid I have to keep a watching brief on it rather than wish for some kind of a more equitable society, as we evolve. And even in AI, right? I mean, the whole AI is that where's the morality in AI? Are there things that we will not do? The development of technology is such that it doesn't wait to answer those questions. It lets the Pandora out of the box first, and then we got to figure out over a generation, if not several generations, to tame that technology, and then society gets into another layer of stability for a while before it goes on to another layer of chaos. So I think that has been the fate of humanity all along, and so we don't expect that we become a more equitable society just because technology enables us to do.
And do you see AI as making things more equal or more unequal? Because many people say it'll increase inequality, it'll further the gap. But then when I look at it, it's actually making things more equal. For example, you mentioned that your staff is not technical, but they're still able to build these agents, these AI apps, and I personally can just go to an AI and ask it and get so much information that I personally didn't have. I can build something that I didn't know. So you have this immense knowledge sharing, immense technical things that are getting shared. So it's reducing the gap and making things more equal. But there is the question of course, inequality as well, as some people did. So what are your views on this? Do you think we head towards a more unequal world because of AI, or a more equal world?
Maybe the answer is not in the technology. Maybe the answer is in the way in which we prepare humanity for the next, for the next phase. And when we say prepare humanity, it means the way in which we prepare the next generation. And I have my finger on education and what different countries are doing to educate their young population. In a lot of countries today, the emphasis is on liberal education, the form rather than the substance. One of the reasons why China has been so incredibly successful as an economy is precisely because it invested in education in the years after the Cultural Revolution, 1976, right? Uh, to this day, from 1976 onwards, to up to 1976, they were a basket case. They used to put intellectuals in jail and so on. And then they reverse course, and they have the most comprehensive and aggressive education policy in the world, both in terms of literacy as well as knowledge, as well as to some extent where they're lacking is the ability to think, but in terms of actual hard knowledge, it's one of the most rigorous education systems in the world. It increased literacy from 76%, something like that, to 99%. India, it's about 70 something percent right now. And female literacy in India is less than 50% to this day. Now, that alone, just the literacy level, tells you how prepared the society is for AI. Just as simple as that. Even if the illiterate in India have access to AI, and AI is delivered in the form of voice rather than having to type text. So therefore, you don't even have to be literate and so on. How they would use AI would be so different from a country which has 99% literacy, and even more different than from a country where there's a high level of STEM engineers, professionals, rigorous education system that knows how to use that information. So really, the issue is not the technology; is the way in which society itself is being curated to prepare for that technology. In a number of countries, they have popularized, they've made education more leftist, more populist, which is make it more simple, focus on the equitable parts where everyone is equally educated to a very low level. Those countries are in deep trouble because with AI, the propensity to misuse information will be much, much higher than countries where getting the facts right are very important. It's just the quality of the society that will decide whether AI will be a boom or a bane, for.
Which fintech trend do you think is overhyped right now, and which do you think is underappreciated?
Fintech trend. We are way past that now. Fintech is dead and over. The whole phenomenon of fintech
Okay.
is ancient history now. The reason is this: fintech was created to automate and take away traditional banking from the traditional banks. In other words, it was designed to do traditional banking better. With AI, traditional banking itself is being revolutionized. So, being a fintech is not good enough for AI. You really need to redefine finance itself and then figure out how you want to play. And what is fintech today? 60 to 70% of fintech have reduced themselves into becoming APIs or patch solution vendors to traditional banking institutions. 70 to 80% of fintechs today sell their services back to the traditional banks. So they really patch, I call them patch solution vendors to the traditional banks, and the traditional banks are able to pick them off at a discount because they're all funded by venture capitalist startups who can't figure out at which point do these fintechs make money. Then you talk about the disruptors. Yes, there are a few, and there are some digital banks as well which have scaled tremendously in payments, for example, and have created a bank-like infrastructure. But now all of these fintechs want to be banks, want to be traditional banks. So the whole fintech proposition lost its way a long time ago. And so we now need a new proposition that is more accentuate to what AI will be doing to revolutionize finance, even at the product front. In other words, if the product changes, the bank has to change.
Yes, that is true. One final question: which Asian market do you think holds the most promise?
Which Asian market is the most, sorry, what do you mean by promise?
Which do you think has like the most optimistic future, one that you would bet on, and holds the most opportunity and promise?
I wouldn't put an Asian. I mean, I would open it up and say it's global, and we need to be looking at the global economy. China had its moment, and I was there. I was very much a part of the Chinese story in its best years. And between 2001, when it joined the WTO, to about 2014, it was the fastest growing economy in the world ever. And that was the result of the investments it made in its social infrastructure from the years after 1976. But since 2014, the Chinese economy eventually matured, and then now it's going into a very interesting transition where the population is declining dramatically. You're talking about a population that at its height was 1.4 billion people, which in 30 to 50 years, it's going to be down 40%. And that will totally change the profile of the economy, and it's an economy that but it can't export in the way that the US has been exporting that. And therefore, when you ask me to think about an economy that I think is the most promising, the first thing I'll say is get all the hubris out of the way. Okay, India is an economy that wasn't interested in becoming a leading economy until China showed up. And China showed the way that being a large and complex economy doesn't stand in the way of becoming the most progressive. And China had its reasons why it did that. And India today says that it can also be a leading economy. It has, demographics on its side. It's got a large, young population and so on. But it's just not made in the way that China is, and didn't go through some of the historical experiences that China did. One of the things I say is this, that the reason China is so successful today is because during the Cultural Revolution, it was able to shed off a lot of its historical baggage and its presumptions about itself as a large economy, and that set the stage for it to become a kind of a liberal economy in that it didn't have a religion. It just took on any ideas that worked and it built on them. India carries way too many cultural inhibitions, cultural baggages to have that kind of accelerated development that China had. You almost want to wish a cultural revolution on India in order for it to be liberated to take off. But you wouldn't wish the Cultural Revolution on any country. It's the worst thing that can happen before the good things happen. So it's not a viable idea. But it will evolve in its own way. That has its own strengths. But it's very important not to get caught up in the hubris of becoming the world's largest economy and all of that. I think that economies that are investing in their young, in education and in social equity will be the ones that will eventually grow. I like to think of Indonesia as promising, but Indonesia has just not picked up any of the opportunities that came its way. Vietnam is incredibly promising and is going through the same transitions that China went, except one phase later, or maybe two phases later, meaning that after the worst points in your history, you have the revolutionaries that rule the country for about 20 to 30 years, and then comes the progressives, then comes the technocrats. So Vietnam is going through those same phases, and so it will be the most promising country in the next 10 or 20 years. But it's not a question that I can answer, on a clean slate, because every economy has challenges that are unique to itself. So you take Singapore, for example, which is today reached the zenith of its evolution. Today is one of the most expensive economies in the world. Anything that a Singaporean can do, its neighbors, the Malaysians, the Indonesians, the Vietnamese, the Filipinos, the Indians can do cheaper. So, excuse me, it's an economy that is finding it difficult to realize the full potential of its highly educated population. Right? So it needs a different game plan in order to sustain its relevance and as well as its growth and economic prosperity. And so each economy is different. We might have surprises. Japan has made a turn and it's investing in itself quite well. It's figured out how to refocus its value creation and create a value in its own assets domestically. Although it's a declining population, it might well take on AI better than other countries. I'm not sure yet, but it looks promising.
One last question. You've also interviewed many people yourself, from CEOs to policymakers and important people. So in your interviews, who has left the biggest impression on you and why?
I don't do much interviewing now. And if I did interviewing, it's only because I wanted access to someone and there's something about that person that I want to tap on. For bankers, I think that, like someone like Cho Sao Chuan, who was the chairman of the People's Bank of China previously, the governor of the Central Bank of China, PBOC, he stands, in my mind, heads and shoulders above any of the Federal Reserve Bank presidents. And I've known at least a few of the Federal Reserve Bank presidents personally. And so the thing is that, and the reason is, here's a man who's been given the opportunity to lead an economy through its growth phases in the most dramatic period in his history, and he did a very good job. So he stands, heads and I mean, like he stands really up there in my estimation. These days, I think about people who are trying to lead the thinking on AI, for example. So, one of my good friends, Lord Chris Holmes in the UK, House of Lords, he's spearheading some of the legislations being put in place for AI safety, AI governance, and so on. Here's somebody who's taking stock of everything that's happening in AI today that 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 needs to be codified somewhat. And the UK actually leads the world in putting together AI legislations. So there are selective people that I handpick, and my access to them. Mark Carney, for example, whom I've had interactions with before he was prime minister, when he was a banker. And honestly, as a former central banker, he was probably one of the most boring people you can think of. Very predictable, very safe, very guarded in terms of what he does. But man, what a good prime minister he's turned out to be. And I thought that Mark has done an amazing job as prime minister, and he did it in keeping with his personality, which is he's always fair to the people he's dealing with. I mean, look at the way he treats Trump. He's calm. He recognizes the things that Trump is doing, which are right, and reserves for himself the right to respond to the things that he thinks that are in the interest of his own country, Canada. Right? He gave a really good speech at the World Economic Forum this year on the role of middle countries as a result of big power politics. So these are the people who are answering questions that the rest of us will find very difficult to answer. And they have to answer real time and put in place tentative propositions that the rest of the world had to follow. So in that sense, I look out for these people. I mean, there are people I wish I would meet at some point whom I actually like, but I'm very selective. I think that today you get a lot of access to most leaders through the interviews that they do on podcasts like such as yours. So I learned from watching podcasts and just getting a sense of who they are, and then when I eventually meet them, I know who I'm dealing with. So I've given up the idea of interviewing to learn. I think now my turn is to do to learn, and that's a very different proposition.
Well, Emmanuel, this has been a very fascinating discussion and you covered so much ground. Thank you for joining and being open and honest and sharing your views. It was really great having you.
Thank you so much, and thank you for the great questions. You actually followed my line of thought, so I'm very grateful for that.